One of the most commonly asked questions is how do you do taxes for foreign invest funds, the FIFs on Investnow? So in this video, I'll be going over how to do that and what is the difference between the foreign dividend rate, the FDR method, and the comparative value, the CV method, and when it's best to use each one. I'll also be taking a brief look at which fund is better for you in terms of taxes and fees, the New Zealand-based AMP Global Index Fund or the foreign-based Vanguard Index Fund. I'll be providing you tips and tricks to help out your financial journey, so be sure to subscribe to the channel. Now, one thing to note that is I am not an accountant, so if you have any further questions, be sure to consult a qualified financial individual. Now, without further ado, let's get into it. What are the foreign invest funds, the FIFs? So these include Australia Unit Trust, the AUTs, which include the popular Vanguard Index Fund, the India Avenue, Morphic, Platinum, and Russell Investment, and all of these can be found on the Investnow platform. And we can filter for these foreign investment funds by using the drop box in the Investnow search function. So if we go into the Investnow platform, so if we go to the available funds on Investnow, we can filter the fund types by the AUTs. And this will give us all the options of the different types of foreign invest funds that they have on offer. Foreign invest funds also include shares that are bought through international trading platforms such as Hatch, First Trade, or Interactive Brokers. In order to do our taxes on Investnow, we need to generate a tax summary using the Investnow platform. So if you go to My Documents and add a report, so you can create a tax summary report, and we want to do it for the last year, and then we want the date to be the 31st of March, and then we just create. And after creating the tax summary, you can download the document into your computer. In the personal tax summary that you have downloaded from the Investnow platform, you would have 5 tabs, which would include Summary, Income, Foreign Investment Fund Income, Foreign Investment Fund Activity, which includes your buying and selling history of your fund purchases, and Tax Credit. Using your tax summary form, your foreign investment tax is calculated differently depending on whether you have under $50,000 in your foreign investment or if you have more than $50,000. In the first situation, you have under $50,000 in your foreign investment funds, so you would qualify for a de minimis exception. In this situation, you are only taxed on your dividends from your foreign investment fund. So to find the dividends tab, just go to the income tab of your tax summary and look for your total income from your foreign investments and put them in the IR3 form, which says total overseas income. And for your foreign tax credit, put that into the total overseas tax paid form. If you have over $50,000 invested in your foreign investment funds, there are 2 options to calculate your taxes. So the first option is to use the fair dividend rate, the FDR method. So in this situation, you'll be taxed 5% of the entire market value of all your foreign shares on the 1st of April, which is the beginning of the tax year. So you would have your opening market value on the 1st of April plus a sales adjustment of the year, and you times that by 5%. And Investnow is quite nice because they will calculate all of that value for you. The second method is to use what we call the comparative value, which is the CV method. So in this situation, you'll be taxed on the total return on your portfolio for the tax year, including any changes in its value. And any negative returns will be rounded to zero, so you won't be able to carry losses forward, which means that you won't get taxed if you have a negative return. So using the CV method, you have your closing value plus your gains from the year, plus the dividends, and you minus the opening value plus the cost. So this is just the way that it's calculated. And again, Investnow does all that calculation for you. So to fill out the tax form, you want to go to the Summary tab, and you want to pick the lower value of either the FDR method or the CV method. So in this situation, the FDR method is lower, and you want to put that into the total overseas income box. And for the tax credits, you want to look for the foreign tax credit in the tax credit box, and then put it into the total overseas tax paid on your income tax form. So which method is better for you? Now, it really depends on your situation. Let's use Bill as an example. So Bill holds 3 offshore investments that can be used either the FDR method or the CV method. So in investment A, he has $100,000 and closing market value is $102,000. And for B, he starts off with $100,000 and he gained $10,000. And in investment C, he starts off with $100,000 and he lost $20,000 for a total closing of $80,000. Now, using the FDR income calculation method, he needs to pay his personal marginal tax on $15,000. Whereas if you use the CV income method, he's actually taking a loss over the combined investment that he did. So it is actually reduced to zero. So he's not actually paying taxes because he's taking a loss. So when do we use each method here? So for the FDR, the fair dividend rate, it is capped at 5%. So you want to use that when the returns over the year are quite high. And definitely you want it over the 5% mark. It also uses your investment value at the 1st of April. So it is good if you want to put a lump sum of investment into your account, because the lump sum added in won't be calculated until next year. On the other hand, for the CV method, it is good to use when there is low or a negative return on your investment, which means that there is no tax. And this is quite useful in the current situation because of all the uncertainty and market downturn. The CV value is quite a good way to calculate your foreign tax obligations. Now, one thing to note is that you have to use the same method for the tax year, which means that you can't use the FDR method for some of your investments and then switch to the CV method. Now let's have a look at which one's cheaper in terms of fees and taxes. The AMP Global Index Fund, which is a New Zealand-based PI fund, or the Vanguard Index Fund, which is a foreign investment fund. So first off, if you have under $50,000 invested, then Vanguard, whether the hedged or the unhedged version is going to be cheaper for you. On the other hand, if you have $50,000 invested at a 17.5% tax rate, you will be paying $633 in total fees and taxes for your AMP fund, and you'll be paying $538 for your Vanguard fund. However, things start to change a little bit when you're in the highest tax bracket. So at a 33% tax rate, the AMP index fund costs $895 because its tax rate is capped at 28%, while the Vanguard fund would cost you $925. Therefore, if you are in the highest tax bracket of 33% personal tax and you have more than $50,000 invested, the AMP Global Index Fund would be the cheaper option for you. In all other situations, the Vanguard fund would be a cheaper option for you. Or alternatively, you're just too lazy to do your own tax calculations, then the AMP Global Index Fund takes care of the taxes for you, which is perfectly acceptable option as well. So I hope this quick tax summary has helped you out on how to calculate your taxes for your foreign investment fund. And it really isn't as daunting as a lot of people make it out to be. And I hope you stay safe during the lockdown period, and I'll see you in the next video.